Growth stocks are not about what a company is today. They are about what the company might become. That difference sounds small, but it explains almost everything about how growth stocks behave, why they can deliver extraordinary returns, and why they can also be a massive disappointment. So, let's slow this down and get practical. This video is not about which stocks to buy. It is about what a growth stock really is, how returns are generated, and what risk actually looks like in this category. Because growth stocks don't behave the way most people expect. A growth stock is a share in a company that is expected to expand significantly in the future. That expansion can come from rising revenues, expanding profit margins, new markets, or new products. But here is the critical part. When you buy a growth stock, you are not paying for what the company is today. You are paying for what the market believes the company will be later. That means growth stocks are priced on expectations, not on stability, not on dividends, not even always on current profits. They are priced on belief. Belief that the company will get bigger, that it will execute well, belief that competitors will not catch up too quickly. And that belief is what drives the price. Growth stocks generate returns in three main ways. First, through revenue growth. If a company consistently sells more over time, its economic footprint expands. Second, through profit margin expansion. As companies scale, they often become more efficient. Costs grow slower than revenues, and so profits accelerate. And third, through valuation, staying elevated long enough for growth to materialize. A growth stock can be doing well operationally and still perform poorly as an investment. And if growth slows even slightly, or expectations were too optimistic to begin with, the valuation multiple can shrink faster than the business grows. In growth investing, returns require both perfect execution and patience from the market. Let's talk about risk. And volatility is not the real risk here. The real risk is expectations failing to materialize. Growth stocks rarely collapse because a company disappears overnight. They struggle because growth arrives slower than hoped. And when expectations are reset, prices can fall sharply even if the business is still growing. Growth stocks are anchored to an imagined future. Now, let's talk about time, as it reveals uncertainty. Every quarter, companies answer questions about growth, profit margins, and execution. When assumptions change, repricing can be brutal. After all, growth stocks are future-heavy instruments. They react very strongly to changes in assumptions. Which brings us on to struggle. Growth stocks struggle when interest rates rise. Uncertainty rises. Investors demand immediate profitability, or competition intensifies. They also struggle when optimism runs ahead of reality. In conclusion, growth stocks are claims on future success. They can deliver extraordinary returns when expectations are met. They can disappoint when reality lags optimism. They are powerful tools, but only if you understand what you are buying.